Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at energy fuels.
If you find our talks useful, please consider subscribe, like, and comment underneath. And before we jump in, make sure to check out the VIP Algos link below in the description. It's a really great tool.
Yeah, definitely check that out. So getting right into energy fuels, ticker UUU. Looking at the data today, at first glance, the chart looks like an absolute train wreck.
Oh, completely. It looks like a classic falling knife situation where you normally just, run away.
Right. But underneath all that scary price action, there is this really wild underlying story. We're talking about the explosive energy demands of AI data centers, a massive billion-dollar corporate acquisition, and, well, literal military conflict in the Middle East threatening global energy.
Yeah, it's a lot. And the market is clearly just confused by what energy fuels is trying to become right now, which is creating some really fascinating pricing dynamics for us to look at.
Exactly. So let's unpack the fundamentals first, because this is where the contradiction just immediately jumps out at you.
Yeah, looking at the financial snapshot we have, if you just look at the top line, things actually seem great. Trailing 12-month revenue is up nearly 22%.
Which is serious top-line growth.
Right. And the gross margin is sitting around a very healthy 34.5%.
Yeah.
So their core business, which is just pulling uranium out of the dirt, it's clearly working. They're making real money on the actual extraction.
Yeah, the core mining operations are completely viable, but the panic really starts when you look a little further down that income statement.
Oh, yeah. The net margin is a staggering negative 82.7%, and earnings per share is negative 30 cents.
It's brutal on paper.
It is. When I was looking at this, I just thought of that one financially responsible friend we all have who suddenly just, maxes out every single credit card they own. You think they've completely lost their mind.
Right, it looks like a disaster until you realize that friend just used those maxed out credit cards to buy a cash flowing apartment building.
Exactly.
Because that negative net margin, it's entirely investment driven. It's not operational decay at all. We are seeing a deliberate, massive compression of near-term earnings to fund a total transformation. Back in June of 2026, Energy Fuels announced a $1.9 billion acquisition of a company called VAC, or Vacuum Schmelz.
So they aren't just blowing cash to keep the lights on. They're spending aggressively to completely change the fundamental nature of what they do.
Precisely. They are pivoting from being a pure-play uranium producer just digging up commodities to a vertically integrated critical materials powerhouse.
Okay, so what does VAC actually do, though?
VAC brings permanent magnet manufacturing capabilities across North America, Europe, and Asia. So Energy Fuels is going from just mining the raw dirt to physically manufacturing the highly engineered components that go into, electric vehicles, defense systems, and wind turbines.
Okay, but let's talk about the mechanics of this business model. Because our research emphasizes a massive competitive moat they already have, which is the White Mesa Mill out in Utah. What makes this one specific facility so special?
Well, it's the only operating conventional uranium mill in the entire United States.
Wait, the only one?
The only one. Think about what a mill actually does. You don't just dig uranium out of the ground and throw it directly into a nuclear reactor. You have to take the raw ore, crush it, chemically process it, and turn it into yellowcake uranium. Doing that requires highly specialized, highly regulated infrastructure.
And from what I understand, you just buy them.
Uranium mill in the U.S. takes roughly 7 to 10 years.
Wow.
Yeah, you have to go through years of environmental impact studies, regulatory approvals, local zoning fights. That dynamic essentially turns the White Mesa Mill into a toll road. If any other company wants to process conventional uranium domestically, they pretty much have to go through Energy Fuels. They hold the keys to the gate.
So they already own the toll road for domestic uranium. And now, by adding VAC, they're moving downstream into manufacturing magnets, creating a sort of Western duopoly alongside MP materials.
Exactly.
But let me push back on this a bit, because a lot of this hinges on the idea of supply chain sovereignty, this idea that the West needs to make its own critical materials. Is that just, a nice-to-have political talking point, or is this a genuine emergency?
If you look at the geopolitical news right now, it is absolutely a national security imperative. It's not just a talking point. For example, the U.S. has been conducting strikes against Iran for 10 consecutive nights because of severe disruptions in the Strait of Hormuz. We're seeing tanker attacks and naval blockades in one of the most critical maritime choke points on the planet.
And the geography of the Strait of Hormuz is pretty terrifying if you rely on imported energy. It's a narrow bottleneck, and you've got roughly 20% of the global oil and LNG supply moving through it. So when traditional energy gets threatened like that, the premium on secure domestic energy just skyrockets.
It really does. And that geopolitical tinderbox is colliding right into another massive macro event, which is the artificial intelligence boom. The energy demands required to train and run these advanced AI models are just incomprehensible.
Yeah, data centers are pulling so much power, they're literally straining local grids. But wait, why does that exclusively benefit nuclear and uranium? I mean, tech companies love green PR. Why can't we just build massive solar or wind farms right next to these new data centers?
Because of how AI training actually works. If you're a major tech company running a multi-billion-dollar AI training model, that system has to run continuously, 24/7, for months. If a massive cloud blocks the sun or the wind stops blowing, a data center cannot just pause a training run. Intermittent power does not work for this application at all. They need absolute, unwavering baseload power. And right now, the only energy source that can deliver consistent, massive baseload power with a zero-carbon footprint is nuclear.
That makes a lot of sense. You need power that is both clean and incredibly dense. 24 hours a day. And we're seeing market signals confirming this, right? Like Trump Media recently merging with TE Technologies, a company specifically focused on advanced nuclear energy.
Yeah, that's a huge signal.
It perfectly highlights how much private capital is suddenly hunting for nuclear solutions just to feed the AI beast.
Exactly. So you have a global energy supply chain under literal military attack, combined with a historic surge in domestic electricity demand from tech companies. Nuclear energy and, by extension, domestic uranium from companies like Energy Fuels is suddenly the only viable answer to both of these crises.
Okay, so if the geopolitical case for domestic uranium is an absolute slam dunk and Energy Fuels owns the only toll road to process it, you would expect the stock to be flying high.
You would.
But looking at the technicals, it tells a completely different, much darker story. The chart looks like a total bloodbath. Let's look at the actual price action here.
It really is a massive disconnect. The stock is currently sitting around $11.74. That is roughly 58% below its 52-week high of $27.90, which it hit back in January of 2026.
Ouch.
Yeah, and if you look at the 13-week return, it's down nearly 44%. So this isn't just a slight dip, it is a sharp, extended structural drawdown.
And I noticed in the technical data that it has a beta of 1.59. And just for context, a beta of 1.59 essentially means this stock is on a trampoline while the rest of the broader market is standing on solid ground.
I love that analogy.
Right. When the market jumps up, this stock launches into the stratosphere. But when the market trips and falls, this stock violently crashes. It's roughly 60% more volatile than the S&P 500.
And that high beta is really working against them right now because the entire uranium sector has been correcting sharply. We're seeing a massive sector-wide deleveraging. The market is in a phase where it's aggressively punishing developers that are burning cash, and it's only rewarding companies that are showing pure execution and free cash flow.
Which puts Energy Fuels in a terrible spot because, as we established earlier with the credit card analogy, they are temporarily loss-making due to that massive VAC acquisition.
Yep.
So they're getting completely dragged down in this sector-wide sell-off. They're being treated like a highly speculative, cash-burning developer, even though they have real, growing top-line revenue from their existing operations.
Precisely. The market is basically throwing the baby out with the bathwater here. But here is where the story gets really, really interesting. When we look at the sentiment data, there's a glaring contradiction. If the market and retail traders absolutely hate this stock right now, what do the people actually running the company think?
Oh, this was my absolute favorite part of the numbers today, the insider flow data. Over the last 90 days, while the stock has been in a free fall, there have been exactly 4 insider buy transactions and 0 sells.
0. None at all.
None.
The people inside the building who are looking at the actual books and the integration plans have purchased over 95,000 shares on the open market. This gives them a 100% management sentiment price ratio.
Let's pause on that for a second because, one insider buying a few shares could just be a PR stunt, or maybe one executive just had some spare cash lying around. But this is different, right?
Oh, very different. This is what we call cluster buying. It's not one rogue executive averaging down on a bad trade. Multiple different insiders across the executive team and the board are deploying their own personal capital into the stock while it's down 44% over the quarter.
So they are aggressively buying the dip, and they're doing it with their own money right ahead of the VAC deal closing. That is the ultimate put your money where your mouth is conviction signal.
Exactly.
It tells you that management firmly believes the broader market is completely mispricing the long-term value of this manufacturing transition.
It's one of the strongest signals you can look for. Insiders might sell a stock for a dozen different reasons.
Yeah.
They need to buy a house, pay taxes, diversify, but they generally only buy for one reason. They think the price is going up.
Okay, but before we get entirely swept up in the insider optimism and this grand geopolitical narrative, we need to balance the picture here. We need a reality check.
Fair enough.
Let's play devil's advocate for a second and examine exactly what could cause this entire thesis to fail. Because buying a massive company is not easy. Energy Fuels is roughly a $2.89 billion company, and they are trying to swallow a $1.9 billion acquisition in VAC.
Yeah.
That isn't just a strategic pivot, that's a python trying to swallow a cow.
Yeah.
How do they survive that integration without choking and going bankrupt?
That is the exact right question to ask, and it's the core of the bear case we're looking at today. The execution risk on this VAC integration is absolutely massive. You aren't just combining two spreadsheets. You have to culturally and operationally mesh a domestic American mining and milling operation with a complex, high-tech manufacturing business that has facilities spread across North America, Europe, and Asia.
Right, you're mixing guys who dig dirt out of the ground in Utah with precision manufacturing engineers halfway across the world.
Exactly. And if that cultural mesh fails, or if they mismanage the supply chain handoffs, the strain on their balance sheet will be incredibly severe. And compounding that integration risk is their exposure to commodity prices. They're still somewhat at the mercy of the raw materials market, which can be incredibly fickle. For instance, the data notes that vanadium prices, which is another critical mineralating process, have recently fallen significantly in China.
Wait, why does vanadium matter here?
So vanadium is often co-mined with uranium, and it's heavily used to strengthen steel and, increasingly, in large-scale battery storage. If the prices of these underlying commodities remain suppressed globally, the cash flow from their core extraction business shrinks.
Ah, I see.
Yeah, and if that happens while they're simultaneously trying to fund a complex multi-continent corporate integration, their cash burn could drag on a lot longer than management anticipates.
And if that cash burn extends, they might have to raise capital by issuing more shares, which just dilutes the current stockholders. Plus, if the broader uranium sector correction deepens, that high beta of 1.59 that we talked about earlier will just continue to work against them. If the uranium sector drops another 10%, this stock could easily drop 15 or 20%.
Exactly. The market environment right now is totally ruthless. It rewards immediate profitability. Until Energy Fuels proves that this fully integrated mine-to-magnet model actually works and, more importantly, generates free cash flow, the stock is going to remain under intense pressure. The geopolitical tailwinds won't save them if they fumble the execution of the business itself.
So, taking all of this into account, the ugly net margins, the brilliant toll road moat, the AI energy demands, the insider buying, and of course the massive integration risks, what's the final verdict from our analysis today? How does this actually score?
Synthesizing all the data, the evaluation gives Energy Fuels a bullish score of 7.5 out of 10.
Okay, 7.5.
Yeah, it scores incredibly high on the strategic thesis. The structural moat of the White Mesa Mill, the potential of the VAC integration to secure domestic supply chains, and those undeniable macro and geopolitical tailwinds are just incredibly strong. But it gets knocked down from a perfect score due to the near-term financial uncertainty and that massive execution risk we just discussed.
So if someone is looking at this stock, how is it generally being approached based on this data?
The consensus points to this being a multi-year play. We're talking a 12 to 24-month horizon. This is absolutely not a short-term swing trade. The main upside driver over the next year will be the successful integration of VAC, proving they didn't choke on the cow, like you said, and a sustained recovery in the uranium spot price driven by those AI energy demands.
It sounds like this is for a very patient investor, someone who believes deeply in the U.S. critical minerals thesis and who has the stomach to handle severe near-term volatility. If you're the kind of person who panics and hits the sell button when a stock drops 10% in a single week, this is probably not the play for you.
Exactly. You have to be willing to endure the turbulence of the Q3 and Q4 2026 integration period. And as you watch this play out, there are two major catalysts you need to track. First is the Q2 2026 earnings report, which will be the first major financial update since the VAC announcement. You want to look for absolute clarity on the timeline for that deal officially closing.
Okay, and the second catalyst.
Looking a little further out into the fall, keep a close eye on potential U.S. Department of Energy funding announcements. Because of the Defense Production Act and the national security emergency surrounding the Strait of Hormuz, Energy Fuels is perfectly positioned to receive significant government support to help build out this critical mineral supply chain.
Oh, wow. Yeah, if the U.S. government decides they simply cannot allow this domestic supply chain to fail, that government backing could massively de-risk the balance sheet concerns that the market is currently freaking out about.
Absolutely.
It's a fascinating setup. You have the ultimate macroeconomic tailwind fighting against severe near-term execution risks. We really hope this discussion today helped clarify exactly what is going on beneath the surface of that terrifying stock chart.
Yeah, there's a lot moving behind the scenes here.
Definitely. But before we wrap up today's episode, I want to leave you with one final provocative thought to mull over on your own. We've talked extensively about how the immense energy demands of AI are forcing a total rewiring of our power grid, and how global conflicts are forcing a rapid decoupling of international supply chains. So, as we look to the future, ask yourself this. Will the most successful tech investors of the next decade actually be the ones studying software and code?
Or will they need to become experts in critical minerals, uranium mills, and dirt-level manufacturing?
Exactly. It's something to think about.
For sure.
Well, that's it for us today. Remember, if you enjoyed this talk, please consider subscribe, like, and comment underneath. And don't forget to click that VIP Algos link in the description to check out an incredible tool for your own research.
See you next time.